If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Shawn Winslow. Let's dive in.
Welcome back to another Finance Friday episode. I'm your host, Shawn Winslow, and this is the Multifamily Money Podcast. What's going on, everybody? You know the drill. Every Friday, we come at you with all things personal finance so we can get your money working not only harder, but smarter. Because after all, it's not what you make, but what you keep. And we want to keep as much as we can so we can build the lives of our dreams, thereby helping our communities and helping others in need and just making the world a better place. And I really think that's what it comes from. How we change the world comes from personal excellence, is from helping ourselves first, so we can then help others. You know, it's what you hear on the airplane, right? The oxygen mask drop, you put it on yourself first before you help anyone around you. And that's what this is. You got to help yourself first. You got to take control of your financial situation before you can really take control of the rest of your life, or before you can help others. And so that's what every Friday is about. I want to come on and talk about topics that I've personally gone through or are going through, or others that I know are going through, that I feel can put us all in a better place. And before I get into today's topic that I think will do that, I just want to do a little housekeeping. As always, thank you for all that come back and listen to the show. I see it in the numbers every week, every month, and it just means a lot. And I really hope that I am bringing value to you, because I know that's important. Time is very valuable to all of us. So the fact that you take time out of your day to play on this podcast and listen, that means the world to me. And as always, if there is anyone else you think could get value from this show, please share it with them. That's how we get in front of more eyes and ears. And as more people listen, the algorithms take control, get in front of more people. Another way to do that is to leave a rating and review too. And I just want to read one here. This is from actually a previous guest, Ken Gee. He said, "Awesome time on the show. Really enjoyed the show. This show is the real deal. I strongly encourage you to add it to your playlist." Thank you for that, Ken. And I had a great time with you on the show as well. We talked about a lot of great topics. And if you haven't heard Ken's show, definitely go back and take a look at it. That was awesome. This is past Monday's episode 152. You know, he's operated and managed over 16,000 units. So anyone who's really curious about operating and managing deals and units, this is the guy to listen to. All right. So today's topic, about getting your money right. One big thing is you got to know where the economy's headed, right? And obviously I'm going to preface it with two things. One, not a financial planner advisor, so I'm not giving any type of financial advice in that capacity, right? This is not like, I'm not telling you what to do, go sell or buy or whatever. I just want to give you what I feel the landscape is based on my research on the market and other economists and investors as well. And two, the other thing I want to preface it with is important to know where the economy is headed for all financial decisions, right? Should you be selling? Should you be buying? And that's any type of investment. Or should you be selling or buying a home? This is all important things to know. Should you be taking out that HELOC or that line of credit? Should you be doing that? Those are all things that you need to know, right? And that's based off what the economy is doing. So today, I want to talk about a thread I came across on Twitter. I thought it was very interesting. The guy I've been following for a while, his handle is MacroAlf. He's a former founder and manager of a $20 billion fund. This was a credit fund, so a fixed income fund. And he's now writer and founder of the MacroCompass. That's, I believe it's monthly newsletter where he just dives into all things, the economics, macroeconomics, really, and even gets into the micro stuff too. And it's really detailed. This is a pay-for newsletter, but, hedge fund managers, investors of all shapes and sizes are a subscriber to this newsletter. So if it's something you're interested in, definitely take a look. I'll have our guys put this in the show notes. So if you want to take a look at the MacroCompass. So essentially the headline, right? The clickbait headline is Alf believes there will be a recession in 4 to 5 months. And so he did this at the beginning last month. So that would put it in about May timeframe, right? April, May timeframe. And before I get into it, first, when we're talking about recession, most would say that the first, signal that there is a recession is characterized by 2 consecutive quarters of negative GDP growth. That's what the media talks about. That's what everyone talks about. Well, recently the media, and the political sphere of trying to, say no, right? But that's generally how it's characterized, right? And that happened earlier last year. However, the thing with this methodology is GDP reports are delayed and often subject to really big revisions. So instead, you kind of want to look at something that's more leading and live data. And so instead, the National Bureau of Economic Research, or NBER, they look at consumer spending, the labor market, and corporate earnings. And this just leads to a more robust method that allows, again, access to live data that we can look at in their leading indicators. Because the GDP reports are what they're lagging, right? Because it's data after the fact. And again, there's revisions. So here's why Alf believes there will be a recession in 4 to 5 months. We're going to look at 4 leading macro indicators. And the first is called the global credit impulse. And so this indicator is when it says the recession will be March, April time frames of 2023. And how bad? Bad. The global credit impulse. So if you find this thread on his Twitter, he shares a chart on a lot of these indicators. And for this one, the chart that is the credit impulse points to negative year-over-year EPS growth in Q1 23. So the global credit impulse, which is the blue line on this chart, if you're taking a look at it, leads S&P 500 earnings growth, which is the orange line on the chart, by 9 months. And given its rapid decline in 2022, it's now pointing to negative year-over-year EPS, or earning per share, growth in March/April of 2023. And these rapid declines in the global credit impulse have preceded year-over-year EPS contraction in the range of 10 to 20%. So that's pretty solid, 10 to 20%, right? So number 2 indicator is the Conference Board Leading Indicator Index. When does this say the recession will be? Again, April, May of 2023. How bad? On par with 2001 at least. And I'm sure there's some listening to this that, either weren't around in 2001 or were way too young to really know. But we all know that led from, the .com bubble into many other aspects as well. And it was a good recession, but not as deep as 08, and didn't last quite as long. However, some could argue reason for that is because we got into a war shortly after, and that tends to take you out of a recession because you're injecting capital into the system to fund that. But I'll digress from that. I digress from that. So again, this index incorporates the top 10 statistically significant forward-leading indicators for the U.S. economy. And over the last 50 plus years, every time the year-over-year series of this index prints in the negative territory for 2+ consecutive months, a recession is guaranteed. This trigger happened in August of 2022, so this past August, and is generally a 7 to 8 month leading indicator. So again, that puts us in the April to May of this year timeframe. Now, the third indicator is the housing market. And obviously, this is a big one for us. This again is a real estate podcast as well as a personal finance podcast. So we talk about real estate a lot. And so this is a big one. And you'll also see why. When it says May of this year, so May 2023, how bad? It says pretty bad. given unemployment rate is supposed to breach 7% by early 2024. So this is kind of why I was just saying, not only is it important that we're talking about the housing market because of this podcast, but in general as a whole. So in 2007, Edward Lemer, if I'm pronouncing your name correctly, of the University of California, stated that the housing market is the business cycle. Now, why would he state that? Obviously, I agree with that. I'm a little biased, but I've been saying this for years, is that housing related jobs and economic activity represent anything between 12 to 15% of the US GDP. So not only US GDP, but also employment. So let me repeat that. Housing related jobs and economic activity represent anything between 12 to 15% of the US GDP and employment alone. So when that takes a hit, the economy really takes a hit, both from GDP growth and from employment. A lot of people will be laid off if that activity slows, right? There's no need for as many realtors. There's no need for as many lenders, no need for as many appraisers. I could go on and on and on. And so it takes a big hit. Now, the NAHB housing index, which again, this is another chart he has on this thread. So if you jump on, you can take a look. And the orange line, which is the NAHB housing index, leads trends in the US unemployment rate, which is the blue line, by roughly 12 months. And according to the SOM rule, a recession starts when the 3-month moving average of the US unemployment rate rises by 50 plus basis points relative to its low during the previous 12 months. And that happened. So again, that points to May of 2023. Now, the fourth and final indicator is called the Philly Fed new orders. And when it says May of 2023, how bad? Too early to say, but probably on par with 2001 at least. And so this is a survey that goes out to 125 CEOs of relevant companies that tend to have a good grasp on where economic activity is headed. And over the last 40 years, every time the 12-month moving average of this index dropped below 15 for 2+ months, a recession has always followed. And this was triggered in September of 2022, and the lead time is 8 months. So again, puts us at that May 2023 timeframe. So to kind of conclude, these 4 leading indicators that have had historically have been spot on to predict recessions are all pointing to a recession between the March and May timeframe of this year. Again, how bad is it going to be? Most of them say pretty bad or on par with 2001. Time is going to tell, both kind of on what the Fed does, right? What are they going to do? Are they going to continue to tighten like they have been? Are they going to go revert back to easing? And I mean like true easing, not just taking the foot off the gas on the tightening like they said, but actual easing. Are they going to, pivot from what they're doing? But if you really looking under the hood, the latest GDP report also confirms organic growth is rapidly trending down, kind of heading below zero. So there's a lot of factors that come into play, but this all points to kind of that March to May. It's probably closer to April to May timeframe of when a recession is headed. I wanted to get on and share this because I think there's been, there's just a lot of uncertainty up in the air right now, right? The market's up one day, it's down the next. Someone's saying a recession's coming. Someone's saying, no, this is the start of the next bull run. You follow the treasury rates, which I do every day. They've kind of been up and down too. There's just a lot of uncertainty, right? And I think this is pretty point blank of what's coming. And I think it's important to know this so you can position yourself. Maybe this is not the time to make big decision that you're not prepared for or well funded for, this is the time to, as they say, batten up the hatches and really prepare, get your house in order. So I thought this was really interesting. Points to May timeframe looks like when this is going to come. And I think that's true. It kind of lags a little bit, right? So even though, it was probably around, I don't remember exactly, but, May to July-ish last year was around when we had the 2 consecutive quarters of negative GDP growth. And it tends to lag, right? So we're pretty much a year from that. And that's when the pain's coming. And it also has to do with, how we've injected capital into the market and the Fed's, play in all of this. But yeah, I just want to get on here and share this with you guys. I thought it was very interesting. Again, check out if you want more detail on this. He really goes into it in his newsletter. So again, that's the MacroCompass, and I will get the link in the show notes if you want to check that out. But as always, everybody, easy doesn't pay well, and instant gratification is self-destructive. So not only get out there and work hard for your money, but have your money work hard for you so we can create the lives of our dreams and in the end, make the world a better place. All right, everybody, catch you on the next one.
Hey, this is Shawn Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course, share it with a friend who needs it. See you next week for another great show.